very warm welcome to everybody. I am Shrija Agrawal and you are watching the first episode of Mint Insight in the new year. Beginnings of the new year are usually a good time for reflections or say course corrections. The year 2019 really has been an year of entropy to say the least, with unprecedented events across the economic, political and social landscape. Be the scrapping of Article 370 or the very fact that the arch rivals in the Indian telecom sectors are coming in a united fashion. If anything, it really showed us that nothing goes according to a fixed plan, foreseeable and undisturbed. According to author Rolf Dobelli, the most common misunderstanding about the good life is that it is a stable state or condition, but the reality is it is achieved through our ability to constantly correct or constant readjustments. So as we prepare to move deeper into the new year, the unexpected events are likely to only accelerate in the coming days. In the fast-paced tech/VC/startup ecosystem, having a perfect business strategy or a perfect investment portfolio or perfect training is no more than a myth. It is now worthwhile to have a harder look in the new year at some of the trends in the ecosystem. The first up really is, how long will the blitzscaling continue? Losing money to win, or what has come to be known as the famous Silicon Valley growth doctrine, blitzscaling, is really coming under scanner. The term was popularized by former LinkedIn co-founder Reid Hoffman. Derived from the Blitzkrieg or the lightning war strategy used by the Nazis in the World War, blitzscaling essentially prioritizes speed over efficiency. However, the recent drummings of the high-growth startups in Silicon Valley, particularly in the public markets, have had the blitzscaling strategy come under deep scanner. There's increasing chatter among the VCs, which is questioning that is blitzscaling a viable strategy. The question now becomes that will 2020 really be the inflection point where we will see VCs drop blitzscaling and choose profitability over growth finally? The second up really is that will Softbank change its investment strategy? The year 2019 really has been the litmus test for Softbank and its famed Vision Fund. It is for the first time that the Softbank Vision Fund faced quarterly loss in the last 14 years. The investment thesis of building monopolies by prioritizing growth, backed by virtually limitless capital with an end game to control market and prices by killing competition, is now being called out. There's a lot of commentary claiming that SoftBank may be gearing to change its strategy of funding hypergrowth. And third up really is the big question that will 2020 really be the year when we will see high growth startups consolidate and finally monetize? The last decade really has seen humongous growth in the startup space, driven primarily by innovation in technology and massive capital. Now, there's increasing chatter among startups that they will either go for a public float, or there's increasing commentary about high-value startups coming together in a bid to consolidate and pursue profitability. The increasing sound bites coming from several startups such as Freshdesk, Pepperfry or Ola contemplating listing. It is yet to be seen who will go for a public listing first, and will it be a NASDAQ listing or listing at the Indian bourses or the home markets? To talk more about some of these trends like blitzscaling, consolidation and more on SoftBank, with me is Rehan Yar Khan, who is a partner to Rias Ventures, to talk deeply at what do we look at the startup trends in the new year. First question to you really, Rehan, is that we are beginning the new year. How will 2020 really pan out, especially for blitzscaling the strategy? What is your view there?
So yeah, it's great that you bring this up. So yes, blitzscaling has been a startup favorite strategy, and I'll just take a couple of minutes to talk about what is exactly blitzscaling. So blitzscaling means that I grow the company very fast by taking a lot of risks and not necessarily getting product market fit. Right, now what is product market fit? Let me de-jargonize it. Product market fit means I have a product which customers love, and I can get the right price for it, right?
Sure.
A price that makes me money. Yeah. So very often companies do products that customers love, but they are so underpriced that when I right price it, there's a risk that may or may not work. Sometimes it works, sometimes it doesn't work. So the traditional startups strategy, one can call it the Silicon Valley strategy in many ways. It's not fair to call it also a Silicon Valley strategy, because within Silicon Valley you have SaaS companies which never followed this.
Okay.
Right? It was only consumer companies which followed the blitzscaling model mostly. So they underprice the product. The whole freemium thing, right, was the other word for it. You underprice it, you give it free, and then later on you rate prices. So what this strategy requires is it requires a lot of venture capital financing because I'm not making money from product, so I need to make the money by raising the money,
Sure.
right? So that strategy is now under question, and the reason for that is because when these companies hit the public markets and they IPO'd, and post IPO, a lot of the stocks tanked. Uber went down. WeWork couldn't IPO. There were other companies, right, which had a lot of issues.
Yeah.
So now the private market guys, which are the venture capital guys, are saying, hey, if the public markets are not supporting this loss-making
There's a
strategy,
public market validation for this kind of hyper-growth mentality.
is not coming.
Yeah.
Is not coming. So we better retune this.
Yeah.
So that is what is happening. That is what happened in 2019,
In
second
a
half
big
of
way.
2019.
Yeah.
That this rethink. So I think we are moving into an excellent era now, right? I think this new decade is going to be a great decade because you are moving in with a lot of sobriety. You are saying that we will grow, but we will also at earlier hit profitability. If earlier on I was pushing profitability out to the 9th, 10th year in some cases, I think people will do it in the 4th, 5th year, which is good.
So Rehan, are you telling me that venture capital is kind of getting boring with this? Because the entire idea of the VC really has been, at least for people like us who've been covering the private markets for very long,
Yeah.
has been that it really is about high impact entrepreneurship
Yeah.
and really funding that hyper growth.
Well, I know you and your audience love the big funding round announcements, the 250 million, 1 billion funding rounds. So I think we'll have to deny you those headlines going forward.
So that era is coming, you're saying?
I think that era is coming, and I for one am thankful for it. We've always had a boring strategy. So in fact, we have a thesis in our fund. We call it tortoise unicorns versus hare unicorns. See, if you remember your childhood tortoise versus hare story, the hare ran very fast, but because he ran fast, he needed to rest. He suffered from burnout. Tortoise went along slowly and finally won the race, right? So I'm also in favor. It will become a unicorn. Right? You will become a $1 billion company, which is amazing, right? It's an amazing thing to become a $1 billion company, but you will take a little bit longer to become that, but with less firing of employees, yes, in a more boring way. I'm sorry to say that. So we are moving, I think, hopefully into a more boring, more steady era.
Okay, talking about that, moving into a more boring and steady era, how has the conversations within the VC fraternity and the dissemination of the message to startups really changed?
I feel, Shrija, that there were very few VCs. I think only 10% of VCs, which, or maybe 25% of VCs, which went for this crazy strategy, right? I think there are a lot of firms which, and certainly firms like us. So one of our criticisms against us has been, okay, boss, you launched 5 years ago and you still don't have a unicorn, right? So I'm like, 5 years, but you want to produce, but there are other guys who have produced unicorns in 5 years, but those unicorns are shaky unicorns, right? I think there is a whole set of firms, right, like us, which have always been conservative, which have been slow and steady, long-term guys. And I think the 25% guys will have to redo their strategy. I think a lot of them must be shaking because, their unicorns are looking very unstable now.
Interesting, you mentioned about the 25% of VC guys,
Yeah.
where the unicorns are looking shaky.
Yeah.
Perhaps the business model somewhere was also to perhaps build for a Softbank. One could say that. And now the unwinding of Softbank happens, like they're pulling out of term sheets reportedly. There was an article saying
Yeah.
that the first time Softbank is pulling out of term sheet.
Yeah.
I think more than hurting Softbank, it will have a spillover effect on the entire VC ecosystem.
So I think the Softbank-like funds, and they were not the only one. There were other. I think Softbank-like funds brought in money at a certain stage, right? Which was the pre-IPO
Yeah.
stage, right? And if that stage is going to be absent, or if that stage is going to not support loss making, I think all the people prior to that stage will have to retune, because that investor is going to look at your books and is going to say, I want to see profitability, or I want to see close to profitability, then I'll invest. So this earlier thing, I just show this massive top line growth, I think people will have to revisit that. You're absolutely right.
So that house of cards can fall down.
I don't think we will see a crash. I think we will see a softening of pace. I don't think there may be one or two companies, which do crash out, but the definition of a crash is more than 40-50% of the market is affected. I don't think so. I think less than 10% of the market is going to be affected with this.
How resilient is the Indian startup ecosystem compared to the West? The WeWork debacle had lessons for perhaps everybody. We're also talking about Decacorns and large-scale unicorns in India,
Yeah.
right? At least when I started covering this space, there was obsession with Flipkart.
Yeah.
Look at how the industry has really panned out here.
Yeah.
Like there's so much of scrutiny on Oyo, for instance. Will we see very large, deep crashes or the softening that we mentioned in the Indian VC ecosystem, you think?
I think anybody who became a Decacorn within 5 years has to worry.
Yeah.
Certainly has to worry, right? Or close to a Decacorn in 5 years. I mean, Shrija, think about it. You start a company from scratch, and within 5 years, your company is worth $10 billion. Is it possible to create that kind of value genuinely? Google maybe can do that, right? Google was a very special company. Facebook was a very special company, right? Maybe they can do that. TikTok maybe is a
Yeah.
very special company.
Going in that direction.
Yeah, but these are all media companies, right? If you
Yeah.
notice, they're all media companies. Media has large impact, right? Maybe Paytm, because again, it has very large impact. But other companies, it's questionable. It is very questionable that you can get so many Decacorns being created in just 5 years, not just in India, all over the world. Is it really? So I think what has happened is that investors looked and said, oh, Facebook can do it, Google can do it. Let me try to create another Facebook. Let me try and create another Google. I mean, we kept hearing that, right? The next Google should come from India.
Yeah.
But, those Googles were not real Googles that were coming. They're pretenders to the throne.
Okay, I also wanted to understand from you, Rehan, that you mentioned that a company becoming a Decacorn in 5 years.
Yeah.
But you can't really only question the entrepreneur there. When VCs were party to it equally. My question is that why only question the entrepreneur and have the glare so much on him when there have been so much large-scale capital providers to fund that mad or hyper growth also, right?
I agree. Not just, I think everybody is complicit. I think entrepreneurs are complicit. I know cases of people who have asked for 500 million and they were told, no, take $1 billion.
If you were to give me like top 3 large key trends for the startup ecosystem
Yeah.
in 2010-20, what would that really be?
One is certainly what we just spoke about, a lot more focus on early profitability, early product market fit, right? So that is one big trend. I think the second trend as far as the Indian context goes is this whole thing of what we call in the fund, what we are calling Next India. So what is happening is that the internet, when it first came to India, was all about the elite getting it, right?
The
2008,
metros,
2000,
yeah.
metros got it, they had computers, the internet was good there. Now it's going to the next India, the next 200 million people are getting the internet thanks to Aadhaar, Jandhan, Paytm, 4G going everywhere. So I think a big trend is going to be unicorns and companies coming by, addressing that market, right? And I think the third big trend is going to be, and this is a little different one, I think there's going to be a lot of domestic participation by investors in venture capital firms.
2020, how can entrepreneur really be lucky? Or so to say, really acquire luck, for instance.
Well, I hope you read my book. So I co-authored a book along with Bob Miglani
Okay.
called How to Make Your Own Luck. And there are 7 chapters in the book where we talk about this. The reason we wrote the book is we kept on meeting people who kept on saying, hey, I'm not lucky, so-and-so got lucky, Bhavish Agarwal got lucky, Sachin Bansal got lucky, Swiggy got lucky, but I'm not lucky, right? But when you go back and you look at these cases of these companies, it's not just hard work, they did certain things, certain things. So we've tried to capture 7 of them. We wrote the book as a way of encouraging people to become entrepreneurs, to go up in their careers, to take up new challenges.
So the hard road is the mantra for 2020.
I think so. Profitability, building slowly, building well, product market fit, and creating barriers to entry.